So you want to really understand The Intelligent Investor by Benjamin Graham.
It's like the Bible of investing.
Yeah, consider the book if you're serious about investing.
Definitely.
We're going to do excerpts and get some expert analysis.
Right.
So think of this as your cheat sheet to Graham's wisdom.
Okay.
Ready to dive in?
Let's do it.
Okay, so first of all, it's pretty amazing
Yeah.
how a book published back in 1949
Oh, yeah?
is still so relevant today.
It's fascinating.
Right. Like the
Yeah.
market's changed a ton since then, but Graham's core ideas about value investing really haven't.
Yeah, and I think that speaks to the fact that he really understood human nature.
Right. Yeah, it reminds me of that saying, the more things change, the more they stay the same.
It's so true.
Especially when it comes to human behavior, how we react to the market.
And that's where I think his insights into market psychology are so valuable.
Yeah.
It's not about following the latest trends. It's about understanding the underlying value of a business.
Okay, so before we jump into the book itself,
Sure.
let's talk about Ben Graham.
Yeah.
The man behind it all. His Wall Street career spanned
Decades.
decades, yeah, from the 1910s to the 1970s.
He saw it all.
He saw it all.
Booms, busts, everything in between.
Yeah, crashes, booms, everything in between.
Yeah.
So what I find so compelling about Graham is that he wasn't just an academic.
Right.
He was out there in the trenches making and sometimes losing money.
Yeah, he had skin in the game.
Right, and that experience really shaped his approach, I think.
Absolutely.
He emphasized a rigorous analytical approach to investing, always looking for that margin of safety. All right, so let's unpack this whole intelligent investor idea.
Okay.
Right off the bat,
Yeah.
Graham says, it's not about being a genius.
Right.
It's more about having the right temperament.
It's true.
What did you make of that?
Yeah, well, I think what he's saying is that your behavior is the biggest factor in your investment success,
Okay.
not necessarily your IQ.
Interesting.
So you need to be patient,
Okay.
disciplined, and eager to learn. You also need to be able to control your emotions and think independently.
So it's like instead of trying to outsmart everyone else or time the market,
Yeah.
you focus on mastering your own
reactions.
reactions. Yeah.
Okay.
And this leads to a really core distinction that Graham makes,
Yeah.
which is investing versus speculation.
Okay. Yeah. Break that down for me. Where's the line between those two?
For Graham, investing is all about thorough analysis.
Okay.
You're aiming for the safety of your principal
Yeah.
and a satisfactory return over the long term. Speculation, on the other hand, is more like gambling.
Right. Yeah.
It's based on trying to predict short-term price movements
Yeah.
and often ignores the underlying value of a business. He even uses this, a 1962 article that recommended short selling
Yeah.
as an example of what an intelligent investor would never do.
Yeah.
Can you elaborate on that a little bit?
Sure. Short selling, by its very nature,
Yeah,
is a very speculative strategy.
right,
You're essentially betting that a stock will go down in price.
right.
And while there can certainly be times when short selling makes sense
Yeah.
for very experienced investors, it's generally not something that Graham would recommend
Word.
for the average person.
Okay, that makes sense.
Yeah.
He even has a pretty memorable analogy to explain this whole idea of market swings, Mr. Market.
Mr. Market.
Okay, what is
Yeah.
what?
Imagine you have a business partner
Okay.
who every single day
Yeah.
offers to either buy your share of the business or sell you his.
Okay.
But his offer price is completely dependent on his mood that day,
Yeah.
which swings wildly between manic excitement and deep despair.
Oh.
That's Mr. Market.
So it's like you've got a business partner
Yeah.
who's totally unpredictable
Right.
and maybe not the most stable person to work with.
Exactly.
Okay.
And Graham's point is that the intelligent investor
Yeah.
shouldn't let Mr. Market's mood swings dictate their decisions.
Okay.
Instead,
Yeah.
you use Mr. Market's irrationality to your advantage,
Okay.
buying when he's in a pessimistic mood
Yeah.
and selling when he's overly optimistic.
So it's not about trying to predict the market's every move,
Right.
but rather recognizing that those moves don't always reflect reality.
Exactly.
Yep.
And that brings us to another one of Graham's
Okay.
key points,
Okay.
which is the two types of investors,
Okay.
defensive and enterprising.
Okay, I'm guessing defensive is more about minimizing risk.
You got it. So the defensive investor
Yeah.
seeks simplicity, minimal effort, and maximum safety.
Okay.
They might stick with a simple portfolio of bonds and index funds.
And the enterprising investor is willing to take on
Yeah, a little more risk.
a little more risk, yeah.
Yep. So they're willing to put in the time and effort to
Uh-huh.
research individual stocks,
Yep.
aiming for higher returns.
Okay.
But Graham emphasizes that even enterprising investors should always prioritize a margin of safety.
So it's not about being
Reckless.
reckless even if you're aiming for bigger gains.
Exactly. It's still about making calculated decisions
Yeah.
based on a deep understanding of the business you're investing in.
And this is...
And for Graham, that comes down
Go ahead.
to
Yeah.
being able to understand and analyze financial statements.
Yeah, that's where things get a little bit technical.
Right. So Graham dedicates a good chunk of the book
Mm-hmm.
to dissecting balance sheets and income statements.
Right.
For example, he highlights ratios like a company's stock price
Okay.
compared to its net working capital,
Okay.
which can help you spot potential bargains.
Now I've got to ask,
Yeah.
why so much emphasis on working capital?
Yeah, that's a great question.
What does that tell you about a company?
Think of it this way. Working capital is essentially the difference between a company's current assets,
Okay.
things like cash inventory,
Yeah.
and accounts receivable,
Okay.
minus its current liabilities, which are the debts that are due within a year.
Okay.
So a healthy working capital position
Okay.
means that the company has enough liquid assets
Yeah.
to cover its short-term obligations.
Okay, I see. So if a company's stock price is significantly lower
Right,
than its net working capital,
exactly.
that could be a sign that the market's undervaluing the business.
That's exactly right.
Okay, so it's a way to see if maybe the market is missing something.
Mhm.
Like the company has more readily available assets
Yeah,
than its share price.
than the current share price.
Share price is suggesting.
Suggests exactly.
Okay, and this ties into...
This is really important.
Yeah.
This ties into Graham's concept of margin of safety,
Okay.
which he considered to be the most important principle for an investor.
Yeah, so you're building in a cushion
You're building in a cushion.
in case your calculations are off
Yeah.
or something unexpected happens.
Exactly. So let's say you're looking at a company using Graham's net working capital approach.
Yeah, okay.
You calculate the net working capital by subtracting the total liabilities
Mm-hmm.
from current assets. Then you subtract any preferred stock.
Okay.
This gives you the net working capital.
Okay.
If this figure is higher than the company's market cap,
Okay.
it could be a good candidate for further research.
Okay, so...
Keep in mind, this is a very simplified example.
Sure.
Graham uses several other methods for calculating intrinsic value.
Yeah.
But the point is to look for a discount.
Yeah, like
You're getting a
you're
bargain
having a bargain.
on a quality business.
Right, on a quality business.
Yeah.
And it sounds like Graham wasn't just theorizing about this.
No, absolutely not.
He actually put these principles
He put them into practice.
into practice, yeah.
Yeah.
So throughout The Intelligent Investor,
Yeah.
he dissects real companies.
Yeah.
American Can, Pennsylvania, Railroad,
Mm.
both successful investments and cautionary tales.
Right.
Showing you what to watch out for.
Absolutely.
Okay, so he's walking you through his thought process, how he applied these concepts in the real world.
Exactly.
Yeah.
And,
He even delves into the world of growth stocks,
okay.
which can be a little trickier to evaluate.
Yeah.
He was particularly wary of overpaying for growth,
Oh,
even for companies that looked promising,
and this was
on the surface promising.
Yeah, and this was way before
Way before
the tech bubble of the late 90s, right?
Right. But his warnings
Yeah.
about overpaying for growth are probably even more relevant today,
Right.
with so many investors chasing
Yeah.
the next big thing or the
Yeah.
next hot stock. So even though The Intelligent Investor was written decades ago,
Right.
it still feels surprisingly applicable to today's market.
Yeah.
Yeah.
It's amazing how relevant it still is.
It is.
Yeah.
And I think that's a testament to the power of Graham's core principles.
Absolutely.
They're timeless.
They really are.
And he also had some pretty interesting things to say about the illusion of growth.
Right.
For example, he points out that a growth stock with a growth rate of 8% or more indefinitely
Right.
would theoretically be worth an infinite price.
Which, of course, is not realistic.
Okay, so why isn't that realistic?
Well, in the real world,
Yeah.
companies can't sustain those kinds of growth rates forever.
Okay.
Competition heats up,
Mm-hmm.
markets get saturated, eventually growth slows down.
Right.
So even if a company is growing rapidly today,
Yeah.
you have to be realistic about how long that growth can continue
Right.
and factor that into your valuation.
So it's not just about how fast a company is growing. Great.
It's about how sustainable that growth is.
Exactly.
Okay.
And Graham uses several examples,
Okay.
like IBM and Texas Instruments,
Okay.
which were considered growth stocks at the time,
Yeah.
to highlight the dangers of overpaying for growth.
Now, I'm curious.
Yeah.
Did Graham have any, success stories when it came to growth stocks, or was he strictly a value investor?
He definitely recognized the potential of growth stocks,
Okay.
but he always stressed the importance of buying them
Yeah.
at a reasonable price.
Okay.
And this is where his approach gets really interesting.
Yeah.
Instead of just relying on his own judgment,
Okay.
he actually highlighted a group of investors he called the super investors of Graham and Doddsville.
Okay, so who were these super investors?
Yeah.
And what made them so successful?
This was a group of investors who consistently beat the market
Okay.
by following the principles of value investing.
Okay.
And what's fascinating is that they had very different styles.
Some focused on small companies,
Okay.
others on large ones.
Mhm.
Some were very concentrated in their holdings, while others were more diversified.
So it wasn't like they were all
Right.
using the exact same playbook.
Right. But they shared a common thread.
Okay.
They all looked for a discrepancy between a company's market price and its intrinsic value,
Okay.
just like Graham taught.
So they weren't chasing...
They weren't chasing the latest fads.
Right.
They were looking for solid businesses that the market had undervalued.
Okay.
And perhaps the most famous of those super investors
Yeah.
was a young
Warren Buffett.
Warren Buffett.
Yeah.
Exactly.
Okay.
Buffett has always said that the most important thing he learned from Graham
Yeah.
was this concept of finding undervalued businesses.
Interesting.
It's fascinating to see how he took those core principles
Mm-hmm.
and built upon them to become one of the most successful investors of all time.
Okay, so we've talked about the intelligent investor, the importance of separating investing from speculating,
Yeah.
and this idea of looking for a margin of safety.
Mm-hmm.
But how does this all play out in the real world?
Well, throughout the book,
Yeah.
Graham uses real-world examples to illustrate his points.
Okay.
He analyzes the histories of various companies,
Okay.
showing how the intelligent investor can learn
Well-
from both successes and failures.
Can you give me an example?
Sure.
Okay.
He takes a deep dive into the case of the Washington Post Company back in 1973.
Okay.
At the time, the company was selling for a fraction of its intrinsic value,
Okay.
according to Buffett's analysis.
Okay.
This was a classic Graham and Dodd bargain,
Yeah.
and it turned out to be a fantastic investment,
Yeah.
to say the least.
Okay, so let's say I'm convinced.
Right.
I want to start thinking like an intelligent investor.
Yeah.
Where do I even begin?
Oh, one of the first things Graham stresses is the importance of understanding a company's financial statements.
Okay.
It can seem intimidating at first,
Yeah.
but it's crucial if you want to make informed investment decisions.
Right, so that's where those
It's all good.
balance sheets and income statements come in.
The balance sheets and income statements come in, yeah.
Oh, okay.
Exactly.
But it's not just about, like,
It's not just about
memorizing formulas or ratios.
memorizing
Okay.
formulas or ratios.
Yeah.
It's about understanding what those numbers actually tell you
Yeah.
about the health and prospects of a business.
So it's like being able to read a company's story
It is.
through its numbers.
It's like reading a story.
Okay.
Yeah.
What kind of things should you be looking for?
Well, Graham focuses on several key areas.
Okay.
One is tangible assets,
Okay.
things like property, plant, and equipment
Mm.
that have real physical value.
Yeah, okay.
He also looks at debt levels.
Okay.
Companies with a lot of debt can be more vulnerable,
Yeah.
especially during economic downturns.
Makes sense, yeah. Too much debt can weigh a company down.
Exactly. He uses the example of railroad companies in the early 1970s.
Okay.
Many of them were struggling with huge debts,
Yeah.
which eventually led to bankruptcies.
Right.
Graham also emphasizes the importance of consistent earnings power.
Okay.
He's looking for companies that can generate profits consistently over time,
Mm.
not just in a single good year.
Okay, so it's about looking for stability and consistency,
Stability and consistency.
and not just flash in the pan profits.
Exactly.
And then, of course, there's working capital,
And working capital,
which we talked about earlier.
which we talked about earlier.
Yeah.
It's all about making sure a company has enough liquid assets
Right.
to cover its short-term debts.
So even if a company looks profitable on paper,
Right.
if it doesn't have enough cash on hand to meet its obligations, that could be a red flag.
Precisely.
Okay.
And Graham even provides some specific ratios and calculations that investors can use to evaluate these aspects of a business.
So he's not just giving you, like, vague advice.
Right.
He's giving you actual tools to use.
He's giving you tools.
Okay.
Yeah.
And it's really about...
And it's about empowering investors to make their own informed decisions rather than just relying on someone else's opinion.
Okay.
Now, another area that Graham delves into is the whole idea of stock splits.
Okay, those were a much bigger deal back then, right?
Absolutely.
Yeah.
Companies used to make a big fuss about stock splits.
Okay.
Almost like it was some magical event that would make your investment more valuable.
Right.
But Graham saw right through that.
Okay.
He pointed out that splitting a stock doesn't actually change the underlying value of the business.
So it was like cutting a pizza into more slices.
Exactly.
You still have the same amount of pizza.
You still have the same amount of pizza.
Just smaller pieces.
Just smaller pieces.
Yeah.
That's a great analogy.
It is.
Isn't it?
Yeah.
And it highlights how companies can sometimes try to use these sorts of gimmicks to manipulate investor psychology.
So it's all about focusing on the substance.
Focusing on the substance.
Not getting distracted by these surface-level maneuvers.
Yeah, the surface-level stuff.
Exactly.
And this ties into...
Graham's broader discussion of investor psychology, which is really one of the most insightful aspects of the book.
Okay.
He talks about how emotions, particularly fear and greed, can drive irrational market behavior.
Okay, so how do we avoid getting swept up in those emotional waves?
Well, he uses a very powerful analogy.
Okay.
He compares the stock market to a voting machine in the short run.
Okay.
And a weighing machine in the long run.
Okay.
What do you think he means by that?
So I'm guessing that in the short term, stock prices are more about popularity and sentiment.
Yeah, like a popularity contest.
Yeah, like a popularity contest. But over the long term, they
eventually reflect the actual value.
They reflect the actual value of the businesses.
Yeah, okay.
Exactly.
So the key takeaway for investors
is to be aware of this duality.
Yeah.
The market can be very emotional and irrational in the short term.
Yeah.
But over time, the weight of a company's true value will tend to win out.
So you need to kind of have the patience to ride out those short-term fluctuations and trust that if you've invested in a solid business, it will eventually be reflected in the stock price.
Precisely.
Okay.
But Graham also recognizes that the market environment can influence investment decisions.
Okay.
For example, he was writing during a time when interest rates were significantly higher than they are today.
Right. In the 1972 edition, he talks about how investors could get a 7.5% yield on high-quality corporate bonds.
Exactly.
Which is the days.
Those are the days. It's hard to imagine those kinds of returns on bonds in the current environment.
Right. So would you say his recommendations about the bond portion of a portfolio might need to be adjusted for today's investors?
It's definitely something to consider.
Okay.
The fundamental principle of bonds, providing a stable base for your portfolio, is still valid.
Okay.
But the specific allocation might need to be adjusted based on current interest rate levels.
Okay.
And your individual risk tolerance.
Okay, so interest rates play a role. What else?
Well, Graham also talks about the importance of diversification.
Okay.
He wasn't a fan of putting all your eggs in one basket.
Right.
He suggests holding somewhere between 10 to 30.
Wow. Okay.
Different stocks in a well-diversified portfolio.
Okay.
And his reasoning for diversification goes beyond just managing risk.
Okay.
He saw it as a way to increase your chances of owning those companies that end up being the big winners.
Because no one, not even the most skilled investor, can predict with 100% certainty which stocks are going to be.
Nobody can predict the future.
The next Apple or Microsoft.
Exactly.
Right.
By diversifying across a range of industries and companies, you increase the likelihood of having at least a few of those exceptional performers in your portfolio.
Okay, so that makes sense for the enterprising investor who's actively picking individual stocks.
Right.
But what about the more defensive investor?
Graham recognized that not everyone has the time or inclination to dive deep into company financials and spend hours researching individual stocks for those investors.
Yeah.
He saw mutual funds as a viable option.
So it was a way to get
It was a way to get
some diversification
and professional management. Without having to do all the legwork yourself.
Without having to do all the legwork. Yeah.
Okay.
And he even dedicated a whole chapter to the process of choosing a good mutual fund.
He did.
He emphasized the importance of looking for funds with low expense ratios.
Low expense ratio.
And a history of solid performance.
Yeah, history of solid performance.
But he also warned against chasing the hottest funds.
Right.
Those that have done exceptionally well in the recent past.
Chasing performance.
Right, because past performance is not always indicative of future results.
Exactly.
What else did he look for in a mutual fund?
He was quite critical of high sales charges, calling them a sales gimmick, and advised investors to steer clear of them whenever possible. He also advocated for a strategy called dollar cost averaging.
Can you remind me what that is?
It's pretty straightforward. Instead of trying to time the market perfectly, you invest a set amount of money at regular intervals, no matter what the market is doing.
So it's more about consistency and discipline.
Consistency and discipline.
Than trying to, outguess the market's ups and downs.
The market, yep, exactly.
Okay.
This approach aligns perfectly with Graham's emphasis on taking emotions out of investing.
Right.
And, speaking of market timing, Graham was pretty skeptical of that, too.
He compared it to trying to predict the weather, right?
Yes, he did.
Okay.
You're likely to be wrong.
Yeah.
More often than you're right.
Right.
He even went so far as to suggest that the average investor would be better off if stock prices weren't readily available every day.
So you wouldn't be constantly tempted to...
You wouldn't be constantly tempted.
It's a check, right.
And react to every little blip in the market.
Exactly. It would force you to focus on the long-term fundamentals of the businesses you own.
Right.
Which is ultimately where the real value lies.
Okay, all of this makes sense.
Yeah.
But I have to ask, how does this apply to growth stocks?
To growth stocks.
I feel like there's a lot of pressure to identify the next big thing before everyone else does.
You're absolutely right.
Yeah.
And while Graham acknowledged the potential of growth stocks, he was also very cautious about overpaying for them.
Okay.
He used the example of Texas Instruments, which was a hot growth stock in the 1960s.
Yeah.
At its peak,
yeah,
it was trading at a price that was more than 60 times its earnings.
Wow. That sounds incredibly risky.
It was.
Yeah.
He used that example to show how investor enthusiasm can get out of hand.
Right.
Driving prices far beyond what the fundamentals justify.
So even if a company is growing quickly, if you pay too much for the stock,
if you overpay,
your returns are likely to be...
Your returns are going to be disappointing.
Pretty disappointing.
Yeah, exactly.
Right.
And I think that lesson is even more relevant today.
Yeah.
With so much hype around certain tech stocks. Yeah, it's easy to get caught up in the excitement.
It's easy to get caught up.
And forget about basic valuation principles.
Exactly. So how can investors apply Graham's wisdom to navigate this kind of market environment where there's so much information overload and hype?
That's the million-dollar question.
I think the key is to remember that the principles of sound investing haven't changed.
Okay.
It's still about doing your research.
Yeah.
Understanding a company's financials.
Okay.
And looking for that margin of safety, buying stocks at a price that's significantly below their intrinsic value.
And not letting your emotions...
Right. And not letting your emotions get...
When the market goes haywire.
Yeah.
Basically, being patient.
Being patient.
Disciplined. Yeah. And focused on the long term.
Those are the hallmarks of Graham's intelligent investor.
Okay.
Now, one thing Graham really digs into is corporate governance.
Okay. What's his take on that?
He doesn't hold back.
Okay.
He's pretty critical of what he sees as a sometimes too cozy relationship between company managers and shareholders.
Like managers looking out for themselves.
Yeah, managers looking out.
More than those who actually own the company.
More for themselves than the actual owners, the shareholders, yeah. He gives examples of companies where managers were doing things he considered questionable.
Okay.
Things like excessive executive compensation.
Yeah.
Self-dealing. And even misleading accounting practices.
So basically not acting in the best interests of the shareholder.
Exactly. Exactly. And he calls on shareholders to be more vigilant.
Okay.
To hold those managers accountable.
He wants shareholders to take a more active role, right?
Absolutely, yeah.
Okay.
He talks about attending shareholder meetings, voting proxies,
and
even speaking out against management practices they disagree with.
And this was back in the 60s and 70s when shareholder activism wasn't as
common
as it is today.
As it is today. It was pretty groundbreaking at the time.
Yeah.
But Graham was ahead of the curve in recognizing that shareholders have both a right and a responsibility to hold managers accountable.
It's interesting how his ideas have had such a lasting impact.
It is, yeah.
Like shareholder activism is much more common now.
Much more common.
And corporate governance is a big deal for investors.
Huge deal.
Yeah.
And Graham saw good corporate governance as essential for a healthy market.
Okay.
And for protecting the long-term interests of investors.
Makes sense. Now, what about dividends? Where did Graham stand on those?
Oh, he was a big fan of dividends.
Okay.
He saw them as a sign of companies' financial strength.
Okay.
And a way for investors to share in the profits.
He even says that dividends should be given more weight than retained earnings.
Yeah, he does.
When figuring out what a company is worth. Which may seem counterintuitive,
especially if you're
make it focused on growth.
Yeah, if you're a growth investor.
Yeah.
But he makes a strong case.
Okay, so what's his reasoning there?
Well, dividends are a tangible return on your investment.
Okay.
It's cash in hand.
Right.
They provide a steady income stream.
Okay.
Which can be particularly valuable for retirees.
So it's not just about the potential for a stock to go up in value.
Yeah.
It's also the income it can generate.
The capital appreciation. It's also about the income.
Right.
Of course, not all companies pay dividends.
Right.
Some prefer to reinvest their earnings for growth.
Right. Which makes sense for younger, rapidly expanding companies.
Rapidly growing companies, exactly.
But for more established companies, dividends are kind of a good indicator of their financial health.
They are.
And a way to reward.
Those
long-term shareholders.
Exactly.
Okay.
And he even suggests that companies that consistently pay dividends tend to be more disciplined with their spending.
Okay.
Because they need to generate enough cash
to
cover those payments.
So that can be a good sign for investors.
It can be a good sign.
Okay. Now, we've spent a good chunk of time unpacking Graham's principles.
We have.
But it's important to remember that he wrote The Intelligent Investor over 50 years ago.
Over 50 years ago.
The market's gone through a lot of changes since then.
A lot of changes.
You've seen the rise of the internet.
Globalization.
And tons of technological advancements.
A ton of technological advancements.
But it's natural to wonder how his ideas hold up in today's world.
Yeah.
Do you think they're still relevant?
I absolutely do.
Okay.
Graham's principles are timeless because they're rooted in human behavior and how markets work.
Okay.
And those haven't changed.
Right.
Investors are still driven by fear and greed.
Yeah.
Companies still try to manipulate earnings and hype up their stock.
Right.
And the market still overreacts in the short term.
Yeah.
But comes back to fundamentals in the long run.
Yeah. So even if the specific examples in the book are a bit dated.
A little dated, yeah.
The underlying principles are still solid.
The underlying principles are still incredibly relevant, yeah.
And that's why The Intelligent Investor continues to be such a powerful, influential book.
It's a classic for a reason.
It is.
Yeah.
It's a reminder that investing isn't about outsmarting everyone else.
Outsmarting everybody else.
Or chasing the latest fad.
Or chasing fabs.
It's about
understanding the basics.
Yeah.
Having patience.
Okay.
And making rational decisions.
Sounds like a recipe for long-term success.
I think it is.
Okay.
One of the things I really appreciate about Graham's writing is that he's not just laying down a rigid set of rules to follow blindly.
He really encourages readers to think critically.
Okay. He wants you to develop your own investment philosophy.
Okay.
One that aligns with your circumstances, your goals, and your risk tolerance.
He's providing the tools.
He's giving you the tools.
And the principles.
But it's up to each individual to apply them in their own way.
To apply them in a way that makes sense for them. Exactly.
And that's what makes the book so empowering.
Yeah.
It's about becoming a more informed and confident investor.
That's right.
Not just blindly following someone else's advice.
Exactly.
So it's less about
finding
the one right answer.
The one right answer.
Yeah.
And more about developing a sound approach.
Yeah.
That works for you.
And that journey of self-discovery.
Right. Is what makes The Intelligent Investor such a classic.
It really is.
Okay.
It can truly change the way you think about investing and money in general.
Well said.
Thank you.
We've covered a lot of ground today.
We have.
But there's so much more to discover in The Intelligent Investor.
There is.
It's a book that you can revisit at different stages in your investing journey.
Absolutely.
And always find something new and insightful.